budget adoption and levy certification. So without further ado, Ruth Shen, our business manager, is going to present.
There's a reason I'm the accountant. So tonight we have two action items, the levy and the budget, and I always struggle with which order to put them in because they're integral to each other. So we'll just go through the documents and then at the end we'll just do both action items if that's okay. So we have the preliminary budget that we previously approved in June that we started the 2021-22 school year with for July 1st. That was the same budget that we took to the annual meeting in August. And then we had to wait until now to get our three key pieces of information that we used to build the original budget and to set the tax levy. So we had the third Friday pupil count in September, the October 1st equalized property values from the state, and then October 15th is when we get the state general aid calculation. So there are a couple documents attached in board documents. There's a summary version and a detailed version. I was just planning to go through the summary version. Unless somebody has questions or wants to refer to the detail, we can certainly bring it up, but we'll kind of see that as we go. The other document is in there is the DPI format of the budget. So when we get to the action items, I will ask you to approve both versions. We need that second one for financial reporting purposes for the audit, please. So if we look at the actual documents, that summary version, we always kind of start with the enrollment. So I did include that document that we're used to looking at. So it has several years of history and then a few years of a projection. So the column we want to look at is the column that says actual of September 2021. It's just to the right of the middle. So that column, those are the students that are actually sitting in seats in our buildings. Okay, so that about a little below halfway down the grand total, 2,926 students. That's how many students are here in our buildings. Then if you go to the very bottom, we always have to adjust that number to get to the amount that we use for the revenue limit. For example, like 4K students, we can only count as 0.6 full-time equivalent to get to that bottom number, and we factor in the open enrollments in and out. So that bottom number, that letter A, the 3,183, is what actually gets carried forward to the revenue limit formula. The column right to the left was the 3,196. That was what we had predicted when we built the budget. We had a low of 3155 and a high of 3237, so we used that midpoint. So a little bit less than what we anticipated, but I don't think it's too far off. And then the trend moving forward then is, as we know it right now, seems to indicate a declining enrollment trend, which just means we will have to adjust our budget accordingly as we go through the years. Then that formula, as I said, goes through that amount per pupil, the pupil count, sorry, I can't talk to me, goes through the revenue limit formula. I was not going to go through that tonight unless anybody has a question. The point I want to make about the revenue limit is that we are proposing to levy to the max under that formula. So I think that's the main point there that we'll talk about as we go through here. So then in that summary, it's the second page, but it's page 5 from the detail. Focusing on that 21-22 column. So those first two amounts there, Fund 10 and Fund 38, the non-referendum debt, those are the two levies that fall under that revenue limit formula. So that's $17,987,000 that is levied to the maximum allowed under the revenue limit formula. The rest of that levy, I'm going to come back to a little bit later when we talk about debt service. So just information there on the bottom are the equalized property values by municipality. And then at the very bottom is the mill rate under one option. There's multiple options, but again, we'll circle back to the levy. So then if we look at I'm going to go on to the general fund budget summary. So it's the third page in the summary version, but page 6 in the detail. A couple things here. This is a one-page summary of the whole general fund. Again, there's the detail. So if you want more breakdown, you can look to that for further information. Or as I said, if you have specific questions, we can pull something up and look at it. I'm going to focus on the October original budget 21-22 column. So it's that third column, and I did include June of 2021, the final, just for informational purposes. So the couple of key lines on the revenue side are the 211 property tax and then the 621 general state aid. Remember, those are the two main components of the revenue limit formula. Just a reminder, under the revenue limit formula, we did not get any per pupil increase. So that revenue limit is not going to change. We have no new revenue. We're just changing the mix of those two components within that. So as you can see, we did get more state aid than we were anticipating previously, which then allowed the 211 property tax line to decrease. Okay, so more state aid allowed us to decrease the levy under the formula, but it's not any more revenue in total. Line that 695, the pupil adjustment aid, that is that per pupil amount that they added, I don't know, 5 years ago, that's outside of the revenue limit formula. So that per pupil amount of $742 has not changed from the previous year, so that's applied to the 3-year average from the revenue limit formula, even though it's outside of the revenue limit formula. So that stayed pretty constant, the $2.4 million. Line 700 federal sources, so that went up a little bit. Most of that is ESSER 2 money that we are anticipating to spend. So even though the revenue side is going up, the expenditure side is also going up. So it nets to a zero impact. I'll try to kind of point out a few of those as we go through this. We do not have any ESSER 3 budget money in here yet. As we talked about previously, we've been patient, holding off until we get further guidance from the state. We were waiting till their plan was submitted to the federal government to get approval there. So we still have to work on a plan that we will at some point bring to the community to get feedback on. We anticipate that to be somewhere in the next couple months here, January-ish. That's what we anticipate right now. So just realize that is not in this budget at all. Then if we drop down to the expenditure side, certainly stop me as we go if you have questions, please. On the salary line, that did go up a little bit, but there are a few things that are in there. The extended care program that we added at Dyer, we did not previously have that in the July budget. So we've added that cost, but then on the revenue side, we also have the daycare fees that we're charging, so that's pretty much an offset. There's also a few salaries that we have put into ESSER funds, so then we have, again, the expense side increasing, but also the revenue side. We do have CPI of 1.23% included in that salary line item, as well as this was a lane year move for teachers. So in the September, we had $163,000 in lane moves. Kind of moving down here, then that 300 purchase services, that's where we'll see some of that ESSER cost money offsetting the revenue up above. We also have in that line is utilities, so there's a little bit of an electric increase. The open enrollments out, that per pupil amount goes up every year. There's some tuition costs in there. There's dual credit classes for the high school students, like at the technical school, the Start College Now program. There's some private school vouchers, but then we also have the revenue on the revenue side and the revenue limit formula to cover. So some of these are the revenue and the expense offset each other. Just going down the 600 debt retirement line, just wanted to point out that decrease is related to the short-term borrowing that we do every year, that we get that phenomenal rate. So we were able to decrease that line item. And then the operating transfer outline, that's the transfer that we make over to Fund 27 that we'll talk about in a minute. Then if we look at the bottom, the very bottom, the increase or decrease to fund balance. In July, we had anticipated a decreasing fund balance of almost 2,000. We were able to reduce that to now a reduction of 482,000. Just to, again, say that we budget conservatively, so we are anticipating this to be the worst case scenario, and that we are optimistic that that amount will shrink before the end of the year, similar to what we've been able to do as we adjust costs through the year, as we've done in the past couple of years. That also leaves us with a projected ending fund balance of a little over 15%, which is a very reasonable level. Any questions on the general fund? I just quickly have special ed, and then we can talk about the debt service levy. Okay. So then the next page, it's the fourth page on the summary, page 12 on the detail. So special ed, the line 611, state special ed aid. I currently have that at 28%, which is similar to what we have had last year. The amount's going down a little bit because we were able to put more cost. Sorry, let me back up a minute. The state aid amount, the state aid that we get in any given year is based on the cost from the year before. So in 2021, we were able to put more cost to the federal aid, which we get dollar for dollar, which means there was less cost. We get aided on at the state level at 28%. So we're better off doing the federal. So that's why that looks silly that it might be going down a little bit. Then the federal 730 federal flow-through line, that's increasing. There wasn't, as part of the allocation, there are some ESSER dollars that are also in that program. So all schools received a higher level than they were originally anticipating. Then on the expense side, salaries were decreasing. We were able to take advantage of attrition, not having to replace some people. that had resigned, as well as some new hires coming in at a lower salary level than people that had resigned. And then the benefits you can see adjust accordingly. So the decrease in the expense and the increase in revenue allowed that top line 110 transfer from general fund to go down. We didn't have to transfer as much in, that ultimately then helps that general fund. Okay. So the only other thing that I wanted to talk about then was the Fund 39, the referendum approved debt. And this kind of goes in line with the, there's the other document there that was the proposed tax levy options. I believe we are in a position to be able to levy extra again for debt defeasance where we can prepay some of our debt. So one option that I put in this budget is to levy an additional $1 million. So this scenario shows an additional $1 million on the revenue side and then on the expense side as well. So then if we can look at that proposed tax levy option document, I want to explain that a little bit. We have three options here. I have a low side and a high side, and we can pick anything in between. So I just picked one, but we can talk about it. So the 2021 column is just there for informational purposes as we compare. I guess one thing to note on the 2021, there are two line 39s, so I spelled out the amount that we levied for 2021 for the additional debt payments. That was the $573,000. And just a reminder, for 2021, we had no levy increase. We were able to do that with keeping our levy flat. Okay, so now if we look at 21-22, option one here is the straight calculation from the revenue limit formula. So as I said, we levy to the max, but that's going to happen no matter which option we pick. The only differences in these options are if and how much we would want to levy extra for the debt defeasance. So it's not going to change anything in the general fund or any of the budgets other than the debt service. Okay. So if we did not levy any extra for debt defeasance, that's that option one, the levy would decrease by 1.3 million or 5.85%. And at the very bottom, then the tax rate or the mill rate would go down to $7.70. A 90-cent decrease, which would be $90 per $100,000 of value on a house, or minus 10.47%. Okay, so that's one option. The second option is, okay, what if we just left our levy flat, no increase or no decrease, similar to what we did for 2021? So then what we're doing is taking that whole 1.3 million from option one and saying, okay, we're gonna use that amount for the debt defeasance. We're gonna prepay 1.3 million of our debt. So under that option, you can see that there's no increase then from 2021. The mill rate would still go down under that, right beneath that gray line there, to $8.18, or a decrease of 4.88%. So then as we were kind of talking, we said, okay, well, what about if there's an option in between? So what if we do some additional for debt defeasance, but also provided some property tax relief? So that's option three. So we said, okay, let's put $1 million extra for debt defeasance. So it's less than the 1.3. So that would allow us to decrease the levy $300,000, or a minus 1.36%. The mill rate would go down to $8.07 or 53 cents. So that would be $53 less on a $100,000 per $100,000 of property value. Now, keep in mind, when we're tracking these numbers, this is the district as a whole. Each municipality is still gonna vary depending on what their property values are in their municipality. So in total, but in general, this is what this will play to. So the mill rate would be $8.07, or a reduction of 6.16%. Now, if you look at 2021, that's very similar, a similar decrease to the mill rate as well as a percent. So it's a nice steady trend. I think it will leave us in a reasonable position going into 22-23. So I personally like that option. I think we're doing a little bit of property tax relief. We're still able to levy extra. That will help us in the long run. So it's still benefiting taxpayers. It's just over a longer period of time rather than 1 year. I like that option, but we can pick any option between 1 and 2 or whatever you want it to be. So, what questions do you have on that? Yes.
Typical interest savings you talked about, like that issues.
Yes. So Bear ran this option for us. So on $1 million, that would save us $415,000. So we are still looking at over a 40% return, similar to what we were able to obtain this year. What they propose is applying that principal to the very last payment in 2039, but then what that does is it saves us interest costs on all the years in between. So even each individual year, the required debt levy would be a little bit less, in addition to shortening the length of the life of the debt.
Did they give a number on the 1.3?
I did not ask for that. But it would be a similar 40%-ish, whatever that calculates out
It's
to.
also about 521, Barry.
Ruth, remind me, last year, what did we do for debt defeasance? Oh, sorry,
The amount was $573,000, and the rate of return, I don't know, was 200. I don't remember the exact dollar amount, 200 something, but it was right around the 40%.
Okay, in case you didn't hear, I was asking last year we did debt defeasance, and you said it was 530 last year?
$573,847. Because we were trying to keep that levy to the exact dollar amount. That's why it was a strange amount.
Thanks.
Just while we're paused, Barry asked the question, if it was the 1.3 million, what that would come out at, and at that 40% break point's about 521,000.
Other questions? Okay, so we would need to do 2 action items, please. One, it might make sense to do the levy first, because that's going to affect the amount that shows up in the budget. And then the second one, to approve the budget in both formats, please.
You want the levy, the option.
You can pick which option you want, or you can come up with an option 4 of something else.
I move we go ahead with option 3 for the tax levy setting for this year.
I second it.
Establish a mill rate of $8.07.
And Roseanne, the second.
I second it, yes.
Roseanne seconded Barry's motion, so the motion is that we're gonna go with option 3, which I believe was the $1 million, is that correct, Barry? Debt defeasance, mill rate of $8.07, which is a decrease of 53 cents, is that right, Ruth, from last year's mill rate?
Yes.
And that'll save us roughly $400,000 over the life, $415,000 over the life of our debt in the district, because we're essentially prepaying some of our interest. Is that fair to say?
It is.
Or, excuse me, prepaying some of our principal on the debt. which will save us some interest.
Yeah, so just a reminder how that works, like, probably early January, February, we will work with Bear to go to the market to actually purchase some investments that we put aside to pay this debt, but by that action allows us to remove it. So in essence, but that action will actually happen in early 2022.
All right, board members, any discussion on this point? Any other questions for Ruth? Okay, hearing none, I'll call for a vote. All in favor, say aye. Opposed, nay. All right, the motion passes. Ruth, do we need a motion or a motion to pass the October budget?
Yes, please, and if you can kind of say it's both formats, that would be appreciated.
I'm sorry, Mr. Bishop. Both formats? you need?
Yes, please. I mean, you can be one motion, but
I'll entertain a motion.
I move that we approve the budget, I think you said in both formats. Yes, please.
All right, motions are made and seconded to approve the October budget that Ruth presented in both formats. Any discussion? Are you hearing none? I'll call for a vote. All in favor, say aye. Opposed, nay. All right, the motion passes.
thank you.
No, thank you, Ruth.
Yes. Another stellar job.
Every year it gets a little easier to understand.
You're a good teacher, Ruth.
Yeah. All right, any announcements at this time, board members? All right. Hearing none, I entertain a motion to adjourn.
So moved.
Motion has been made and seconded. Any discussion? Hearing none, all in favor say aye. Opposed, nay. All right, we're adjourned. Thank you. Thanks to everyone for coming too. Appreciate it. See you guys.